risk tolerance is how you feel about risk for most people. What it should be about is how much risk can you handle in your portfolio. You should be able to detach yourself from the emotions of risk. But the riskiest thing about risk is what it could cause you to do, how it could cause you to behave with your investments. So, for example, if you're young, let's say that you're in your 40s or your 50s and you've got a good 15 to 20 years before you're actually going to retire. And you're building a portfolio because you know that with inflation like it is, you need to grow your money to be able to meet your future income needs in retirement. Well, for most people, you can afford to have a higher risk tolerance, meaning the risk in your portfolio is going to dictate two things. It's going to dictate volatility, meaning how much return you can get on the upside and how much temporary, or long-term gain you can get in the long term, and how much volatility to the downside you could potentially see in the short term. So the biggest problem with long-term investors is that sometimes they will abandon a really good long-term plan because of downside volatility in the short term. So they will allow a market decline to make them pull their money out. And a lot of times when people actually pull the trigger and do that, they've gotten to the point where they have so much fear about being invested in equity investments that they will never get back in. So that can really be detrimental to a long-term strategy. If, let's look back to the financial crisis of 2007 through 2009. In that 17-month period, the S&P 500 went down more than 50%. So long-term is really defined as 8 to 10 years. This had been a 17-month period where the market went down, continued to go down, and nobody knew how long it would continue to go down. In fact, one of the major brokerage firms, now looking back on the day of the bottom of the market, their headline was S&P 500 set to, I don't remember exactly, so I'm paraphrasing here, set to go down another 40%. So fear was at its peak, and that ended up being the bottom of the market. But let's say that you were there, you were down 50%, you heard that headline that it's going to go down another 40%, and you're just like, I got to get out. If you would have gotten out at that time, you would have locked in a 50% loss if you were 100% in the S&P, which you probably wouldn't have been. But just for illustration's sake, if you're down 50%, you have to make 100% return just to get back to where you were. So 17 months seem like a really long time because we live in the short term. Our emotions are influenced by what we're hearing, what we're seeing, what we're experiencing, and we can lose sight sometimes of that long-term time horizon. So if you got out, you needed 100% to get back to where you were. If you panned out and looked at that 10-year period starting right before the crisis, right before the market went down 50%, so 17 months there. If you went 10 years out later, the market had actually averaged 10% per year. But if you ask somebody when the market was down 50%, do you think you're going to make an average of 10% if you stay in the market? They would have said, no way. There's no way I can. I'm down 50%. So what happens when you move to cash at that point? Well, if you move to cash, over that 10-year period, interest rates went really low. So we went into a time frame when you couldn't hardly get anything for your cash. So odds are you're probably, if you got out and stayed in cash, you're probably nowhere near to recovering. Whereas if you had stayed in, you would have. So you really have to assess, what would you be willing to, at what point would you be willing to abandon your strategy? And the other part of that is that you have to have some confidence in what you're doing. So if you don't understand your current investment strategy, you probably shouldn't be in it. So you should be spending a lot of time right now to understand what your strategy is, to know generally what you're investing in. And the more likely you are to get out, the less risk you should involve in your portfolio. So you should lean more towards those fixed income type investments, really more towards CDs, because as we learned last year, fixed income has risk too. So fixed income has interest rate risk. And if you're in bonds, especially long bonds, just like we're seeing in the banking crisis now, these are the consequences of a rising interest rate environment, that fixed income investments can and do lose value. I mean, not only were the equity markets negative last year with the S&P being down around 20%, the NASDAQ being down 33%, the bond markets were down between 15 and 25%. And metals were flat. So, you have to be willing, no matter what you're in, to experience the downside. So just spend some time knowing what the downside is. Try to get a good idea of what normal behavior is for the portfolio that you're in, so that when you experience it on the upside, you won't get too excited. When you experience it on the downside, you won't get too worried.